I'm going to start with just one slide here. I'm going to leave this up for a while. This is a long-term chart of the US equity market going back to 1871. That's a tremendous amount of history, and we thank Robert Schiller of Yale University for having compiled all this data. I want everybody to just kind of take that in for a while I distract you with a little story. Has anybody seen the movie A Beautiful Mind? All right, there's got a few. Oh, good. I saw that with my youngest daughter as part of her psychology class. Fascinating movie, very interesting guy. Biographical story of Dr. John Nash, a Carnegie Institute and Princeton trained mathematician who actually wound up winning a Nobel Prize in economics for some of his work in game theory. Among his many accomplishments, he actually worked for the Department of Defense during the war years as a encryption decoder. And it was amazing that the story, and I don't know if the movie was truly accurate, from the reviews I've read, it may have taken some liberties. But during his time at the Department of Defense, he was able to break encryptions, the German encryptions, just by looking at them, which amazed me. He could, and they depicted it in the movie, very, very cool, showing large walls of data and numbers, and in his mind you could see the numbers popping out and him deciphering the sequences. I thought that was fascinating. Someone who likes to look at pictures, it was really inspiring. So going back to this, what I want to start with is, if we go back and we really think about starting with a clean slate, what has really gone on in the last 140 plus years that we can get this data back? Well, the first thing I see, if you look over the entire period, is we have basically an upward trend. Average is about 4.5% over the entire time period since 1871. But you can see in many places it's really pretty far off the trend. So there's a lot more going on than just a simple upward trend. So if we go back and again, start with this clean slate, think about it with an open mind, what else do we see going on? Well, to me, I think you see a very clear distinctive break right around the post-war era. And you get two very distinctive trends when you trend fit a line in these periods. The more recent post-World War II modern era, you get about a 7% trend, which if you talk to a lot of your financial advisors and you talk about assumptions for equity returns, that's usually what you get in a ballpark for US equities is maybe 7%. The pre-war period from 1871 through about 1942 is only 1.8%. That's a very big difference. Still not quite really happy with what I see though. You still see some areas where you get very big divergences. So we thought about taking a different approach. Rather than looking for the upward trends, think about looking for what other patterns you might see here. To me, the thing that inspired or intrigued me, I jumped the gun. These sort of periods of flat trends in the equity markets where they bounced along, but really they didn't go anywhere over a long period of time. So what we did is took the, 1,700 months worth of data and went and found each time the market hit a new high, and then went and looked for the last time, the last date that number occurred. So for instance, if we look over here, the first time it crossed, I think it was about 8, and then the last time it was at 8 was here. It never came back to 8, so that was the last time. So taking that methodology, looking for the first time it crosses a level and the last time, we come up with these 4 periods here of basically flat trends. Very interesting. And they vary in time and length. The first one there is about 25 years. The second one from 1901 to about 1942 is 41 years. More recently, we've had these 2 periods in here, which lasted about 12 years each. So good news for us, post-World War II, it seems like we're getting fewer and shorter of these flat periods. But as we know, the future is totally unpredictable, so we don't really know what's going to happen. But it's interesting to think about what goes on during these periods. And of course, in between, you have these up periods, these upward trends, very strong upward trends. So you're getting returns of low double digits, 10, 12, 13% in these upward periods, intermingled with these long periods of sort of flat. So that becomes really sort of the interesting question that I started to do research on, is if you think about what drives the markets in these long trending periods. Well, for use in investment management, if you're going to use any kind of indicators like this, they need to be predictable. Otherwise, it really is nothing more than an observation. And if you think about what big factors drive the markets over these either long flat periods or long upward trends, it'll be things like policies in place, say opening up a free trade globally. It can be demographics. Certainly we can see at least some lead time with birth and death rates, length of life getting longer. We don't know as much about immigration policies, but that certainly can have an impact. Probably the biggest driver is technological innovation. When the economy is structurally changing, new technologies are coming along and how quickly they're deployed and put to use in the economy. So these are all really tough things to sort of predict. And again, like I said, if you can't predict it, it doesn't really help you much. So the second question becomes, what are the implications of these different periods for investors? So in other words, if we don't know what the future holds, what would it mean if we go into another long period of flat equity markets? I mean, it's conceivable. Japan right now had hit its last equity market peak in 1990, and it still hasn't returned to that. It's been flat for 20, or at least flat trending or lower for 27 years now. So it's not impossible. Well, if we can't predict these long trends, then what else can we look at? Well, you can see during each of these trend periods, whether it's a flat trend or an upward trend, you've got these cycles. So if we separate out these trends, take the trends out of the market and just look at the cycles, this is kind of what it looks like. It's pretty messy, I know. It gets a little ugly, but you definitely see a lot of ups and downs. And of course, being part of the American Institute for Economic Research, the first thing I think about is what's the impact from business cycles. Normally you would see the recession shading highlighting the recessions all the way back to 1871. They're highly correlated to these business cycles, to the equity price cycles. Now that takes away a really sad point.
Just tell us where the shaded area would be so we could...
Yeah, well, I can try and work you through some of these. That's really unfortunate. Well, we had recessions. We can work our way backwards. So we know there was a big recession, the Great Recession here. There was another one back in 2000, 2001. We had a 90 recession. We had the double dip recessions in 80, 81. In fact, most of these correlate to an economic business cycle, a recession. So again, for any of this information to be useful, it's got to be predictable. Well, luckily at AIER, we've had business cycle research and a business cycle model in place for many decades. There we go. This one you can see the recession shading. Okay. So this is our business cycle model. We just updated this model. It's been, in some form, it's been around since 1950. It started out life known as statistical indicators. We now call it the business cycle conditions model. For people who aren't familiar with it, I'll just give you a little side brief in it. The business cycle model has three components to it. It's got a leading index, a coinciders index, and a lagging index. Each of those indexes are made up of a group of indicators. There's 12 economic indicators in the leaders, 6 in the coinciders, and 6 in the laggers. The indicators are combined into a diffusion index, which is a breadth measure. So it's the percentage of the indicators that are either trending higher, trending flat, or trending lower. And we've found that over time, it's actually done a pretty good job predicting upcoming business cycles. On average, about 3 months ahead of time. And the nice thing is, with our new business cycle model, we are able to calculate it anytime. We can do it daily if we want. It used to be only monthly. And we can distribute it and disseminate it much more quickly now with the internet. So this, to us, becomes a potential tool that we might be able to use in investment management. So here we are looking at it versus the S&P index, and you can see much better now that we get the recession shading. So our indicators start declining well before, this is the official recession, the gray shading. The S&P 500 shows a big decline, and you can see it happens in pretty much all of these last, we could talk a little bit about the current economy. Actually, I can tell you we updated the model. It's now at 42, so we're still kind of hovering below 50, but it's not that bad. It's actually, to us, it's really very consistent with a slow economy, not necessarily calling for a recession. So you can rest at ease. I don't think we're going there, but we can talk more about it later.
Cancel my call orders.
That's right. I think we're safe. Okay, so in order to really test this, though, pictures are nice, but eventually the rubber has to meet the road, and we do some back testing. So we actually set up a scenario where we can test the indicator statistically to see if they can actually improve performance. So here's the way we ran these backtests. I'm going to show you a set of 4 backtests. Now the first thing I want you to know that this is all in sample. Now what that means is the model is calculated today throughout its entire history with all the knowledge we have today. So it is not a realistic, in other words, if you were going to do an out of sample, you could only calculate based on the information you knew at the time. We are going to change the methodology so we can do this out of sample testing. But for right now, the easiest way to just see if there was even a proof of concept here was to do it in sample, and we'll show you the results. They're really kind of interesting. We're going to use a 3-month average of that leaders index. We're going to start with a portfolio of $100,000 in May of 1968. That's as far back as our model will allow us to go. The initial starting allocation is going to be 100% in equity, just the S&P 500, and nothing in cash. And throughout the model, it will simply go between equity and cash. No other instruments, no other assets, just between equity and cash. Now here's the decision rule. Again, there's lots of ways to implement this, but here's one we found through a Gaussian technique. We've narrowed it down to this simple rule. If the index is below 34, remember we're at 42, so we're okay. If we're below 34 and falling, we're going to decrease our equity exposure. If the index is above 8 and rising, we're going to increase the equity exposure. And that's it. And the only thing we're going to do in 4 different backtests is change this percentage that we increase and decrease by. Does everybody understand? Any questions on that? Yeah.
Is the equity exposure just the loan portfolio, or does it include ETFs?
It's just a benchmark index. So it would be done in simple ways through an ETF, just being in and out of, say, the spider. Any other questions? Okay. So let me just explain a little bit more on this buy and sell rate. It's really how quickly we get in and out of the positions based on the model signals. Okay, for instance, if we had a sell rate of 10%, the first time we get a sell signal, you'd reduce your equity exposure by 10%, so you'd go from 100 down to 90. If you got a second month, a second signal, you would then reduce by another 10%. 10% of this brings you down to 81, and then so forth. So at a 10% sell rate, after about 6 months, you'd be about half your equity exposure, half in equities and half in cash. Okay? If you increase your buy or sell rate, say up to 15, then you're about at the halfway point after 4 months, so you're getting in and out more quickly. And same thing if you go up, say up to 33%, fairly quickly, moving in and out very quickly based on these buy and sell signals, you would hit your halfway point in just 2 months. Now keep in mind, we're showing here a list over about 10 months. In the post-World War II era, the average economic cycle has only been 11 months. So you don't have a long time to move in and out, and equity markets move even more quickly than the business cycle. So the trade-off here is how quickly you want to move in and out versus how quickly the markets are moving. Any questions on sort of the buy and sell rate and how it works? Okay. So here's our first.
How does the buy rate work?
It's usually reversed using cash. So whatever cash balance is outstanding, you go back to it for a second.
So you just go from 73 to, if you work between the second and third month at 10%, you go from 73 to 81.
As you sell out, you would sell a portion of your cash balance. So in other words, if you're, okay, so if you now are, say, 50-50, whatever the dollar value of your cash is, you then sell that amount and buy back into equity. Does that make sense? Okay. Okay, so the results from the first backtest, and we're going to do these. This first one is fairly conservative. We're going to have a sell rate of 10%. So again, it takes 6 months to reduce your equity exposure in half. Buy rate's a little faster. One of the things we found, and this is consistent with the results of our economic model, the model is better at calling peaks in the cycle and not quite as good, not as much lead time in the troughs. And in general, you'd like to stay fully invested or as much as you can. So we're going to, in all of our backtests, we keep the buy rate faster than the sell rate. So we go back, again, back to 68. We have a total of 579 iterations, months, in the backtest. We have a total of 228 transactions. We do include a transaction fee of $20, figuring if you're doing it on E-Trade or whatever, it's only $8.95. We have a total transaction cost over the entire period of about $4,500. Distribution of the transactions, about 30% or so are buys, 10% are sells. 60% of the time, you're on hold. So you're not doing that much trading here. And again, this is all done over 48-year period in the backtest. So how did the portfolio do? The reference, the basic S&P 500, if you started with $100,000 in 68, you would have ended up with 2.2 million. Our portfolio, adjusting the equity allocations, you'd have 2.56. So you've gained an extra $350,000, a difference of about 16% over that entire period. Not too bad. And that is net of transaction fees. The annualized return goes from 6.6 up to 7. So not too bad. If we take a look at it visually, it's kind of interesting as we get some, and there is no shading on here, so we don't have to worry about the missing bars. You can see where the model really pays off. In some of these big downturns, the blue is the benchmark, the red is the model. We've lowered our equity exposure, so our total portfolio doesn't decline as much. In both these recessions back here, the model works just as we'd hope. So we open up the gap here. Anytime there's a gap widening, that means you're outperforming. When the gap narrows, you're underperforming. Over most of the period, it actually trends the same. So we open up a gap, we outperform. Here in the 1980s, in the double dip, we lose our advantage. It comes right back. We're about in line with the portfolio. We stay in line. In the 1990 recession, again, the model doesn't work as well. It was a fairly mild recession. And again, the shorter the recessions, the less time to react to the movements in the market. So it's not that surprising. We underperform. We underperform by this gap. This gap remains relatively consistent, but we underperform through the 2000 peak. Here in this decline, again, we close the gap. The model will close the gap, so we're outperforming. We underperform just slightly here. But then in this latest, the Great Recession, we outperform by a significant margin. And again, this is one of the characteristics of this model so far, the way it's been developed, is for it to really work the best, you need a fairly substantial recession with a fairly substantial decline in the markets. So it's really protecting you against the big moves. It's not designed to do every little up and down in the market. It's not, and it won't in fact capture small moves, and it's less effective during the shallow recessions. It really is more effective during the bigger, more serious recessions and bigger, more serious declines. Here's another way of looking at it. I apologize for the harsh color. It stands out nice and bright. So this is your equity allocation. If you think about your portfolio over time, the percentage of your equity portfolio in equity, it's on the right scale. So anytime the green's at the top, you're fully in equities. And these white times are when you're selling out and reducing your equity exposure and increasing cash. You can see there's 1, 2, 3, 4, 5, basically 6 episodes throughout this almost 50-year period. So again, you're not trying to time every little movement. This is really focusing on protecting your investments, the equity allocations during a business cycle. All right, so what happens if we change our buy and sell rates? We'll increase them a little bit, so we'll get in and out of the market a little more quickly. We're down to 178 transactions total. We've reduced our transaction cost by about $1,000. We're now at about 20% buys. Sells didn't change at all, about 10%. And holds are up to about 70% of the time. Overall performance, same 2.2 million in the base portfolio. We're now up to almost 3.5 million. So that's a difference of 1.25 million. We beat the base portfolio by over 50%. We've increased our annualized returns by a full 100 basis points over the entire period. If we look at it graphically, how'd we do? Again, you'll see the same patterns emerging. It really outperforms in these deep ones. Doesn't do as well in the double dip. You can see the gap closes here, closes up here. We outperform better now because we're moving in and out of this cycle, and we really outperform in this last Great Recession. Here's the equity allocations. You'll notice a couple things going on here. The whites at the top are getting narrower, so you're in and out more quickly, and you're getting steeper cuts in your equity allocation, in some cases going below 20% for the equity exposure during these business cycles. All right, one more time. We'll go 33 and 50. So again, now we're really getting in and out even more quickly. Nice results, I think. Transaction fees are going down. You're still on hold about 75% of the time, and we're now outperforming by over 100% over this period. Annualized growth rate, 6.6 versus 8.2. There we go. If we look at the, bless you, if we look at the performance of the model portfolios, this model portfolio never, it gets a gap at the beginning and never looks back. It maintains a performance benefit over the entire period, and the gap widens, particularly as we hit again this last most severe recession and business and equity market decline. The equity market exposures, again, you can see because you're getting out more quickly, you've got very narrow white areas here when you're going to cash, but much more severe. In some cases, your equity exposure is getting almost to zero. And then finally, just to take the extreme case, if you were to get in and out 100% on the first signal, so very aggressive trading on this type of behavior, but just to see what the potential is, we're now down to just 28 transactions over a 48-year period. That's 2% buys, 3% sells. 95% of the time, you're sitting and holding, and you're going with the market. So this is really very concentrated moves, anticipating the business cycles. If you do this, if this model is accurate, we're going to do more testing, you would more than triple the performance of the underlying base S&P index. Again, just the model outperforms. And again, you'll notice the key thing, it really becomes obvious here how in these periods of down, our model portfolios becomes flat to avoid the downs, and the rest of the time it sort of follows the market. And that's really where we're trying to make up the most, is during these severe market turndowns, severe business cycles, protecting against those downside losses. All right, let me just emphasize, these results are all preliminary, okay? Don't go home and do this. Don't try this at home. Results are, I think, interesting enough that we're going to continue this. We've got a lot of things planned. We're going to certainly switch our methodology to do the out of sample, which will be much more realistic. We're going to try other methods for moving in and out. Rather than percentage of the portfolio, we may target percentages. We may look at using this model in conjunction with other economic indicators. One of the very exciting things we're doing is we're now expanding, we're building business cycle models for other countries, and we will then, once we find a business, if we can get business cycle models for other countries working, we will put that through the same testing we're doing here to see if we can work with other equity markets around the world. And again, these are very preliminary. Please don't think you can go home and just follow this model. This is all being tested. We have a lot of work to do, but I think it's really exciting, and we're really looking forward to testing this in the future. Just want to thank Robert Schiller for all his data. Any questions?
What about the effect of taxes?
Yes, we didn't. We want to see if there was just a proof of concept of usefulness to the model. Everybody's taxes are different. We could model them in, but at this point, we just want to see if it seems like the model is going to be effective. And that's really where we're going to start. Yeah.
A significant portion of the S&P 500 companies have non-U.S. income and cash flow. Is there any way you could allow for that in doing this? In other words, do your leading indicators also take into account international economic growth?
They do sort of implicitly by the nature of the indicators we're using, but no, we're not really accounting for that sort of factor. And it's a very good point, because as you know, everything changes over time. The economy is always growing and changing, and certainly throughout the last several decades with increased trade and then moving operations overseas, yeah, a lot of companies are getting a lot of their revenues from outside sources. I hadn't thought about that until you brought it up, but it's actually another great one of those questions we can look into, if there's a way to possibly combine business cycle models for other countries all into one model and to sort of look at a global portfolio. But so far there seems to be more, I mean, the markets around the world are correlated to a degree, but I still think most of the equity market performance is driven by domestic fundamentals, even with foreign exposure growing. But it's actually a very good area for us to look into as well. Yeah.
In the 3 different types that you use in your model, you mentioned there are 12 indicators for leaders and 6 and 6. Can you talk a little bit about what the components are?
Well, you're going to put me on the spot and see if I can name them? Okay. Well, I can tell you, out of the 12 leaders, we made a big effort in the redesign of the model to keep the indicators broadly representative of the economy, so we're not concentrating on any one thing. There are financial indicators, labor market indicators, sales and order indicators. I can see if I can name them. And anybody wants to jump in, feel free. There's initial claims for unemployment insurance, the average work week in manufacturing. Boy, this is going to be tough. Real new orders for consumer goods, real new orders for core capital goods, employment population ratio, is that? S&P 500. We have financial indicators, the yield curve spread, debit balances on margin accounts. I know I'm forgetting a few. Heavy truck unit sales, thank you, yes. Heavy truck sales. So tractor trailers, buses, that sort of thing. You know, it's a shipping economy. Everybody's using Amazon.
Yeah, that last one, the trucks, that's the equivalent of Alan Greenspan's favorite indicator, freight car loadings.
It is similar in a way. It depends on whether they're shipping by rail or by road, but we found it actually was distinct enough from other capital goods indicators, and yet still was a good indicator for the model. It's one of the new ones we added. I can tell you in the latest revision we had, out of the 12, I think we dropped 5, and 5 old ones and added 5 new ones. I think it was 7 of them stayed the same. Yeah.
In your back test, are you using your revised model for the signals, for the buy-sell signals?
Yes.
So it's not the methodology that was in place at the time historically?
Correct. Yep, it's new, it's completely quantitative. Again, if anybody's interested when we did this update of the business cycle model, the way it was done historically was each of the 12 individual indicators in the leaders index was evaluated. We got the researchers together, everybody evaluated the indicator, deciding whether it looked like it was in an upward trend, a flat trend, or a downtrend, and then we combined them into the index. For the new model, we actually have the computer do all that. We've done a significant amount of statistical testing. We allow for what we call a fat zero, a bandwidth, in order to generate a signal. But it's all quantitative now, and the role of the researchers are now to evaluate the results of the model rather than have input into the model. So the model, to me, is more robust, more quantitative, but it still allows us to look at it and interpret it. And actually, if I can, let me go back. I'll flip quickly back to the current conditions. So here we are. Again, this is interesting when we're just looking purely at the model. We're kind of hovering in this range below 50. Historically, when it got below 50, that's when we started thinking about, is a recession coming? It wasn't automatic, but that's when we started getting concerned. There was still a subjective element to it. In most cases, you can see the model when it goes down. And we did have this one period here where it was hovering for a while before it fell, but it was at a significantly lower level. So this is kind of interesting, the fact that it's sort of unprecedented. We're hovering in this slightly below 50 world, which raises flags, and we've been saying, if you've been reading our pieces, we think the risk of recession is elevated, but it is not the most likely scenario right now. We still think the sort of the slow growth outlook is most likely, and this is actually very consistent with that. Yeah.
Would you recommend, you think long-term, using the very aggressive changes? Because it would worry me if the signal were wrong, whether you'd really mess up.
Absolutely. Absolutely. At this stage, can't recommend anything other than don't do this. Okay, this is not at all ready for prime time. I can imagine lots of ways of using it. If you think about most asset allocations now, and it's very suitable for most people. If you do an asset strategic allocation, it's really essentially a buy and hold. You're determining what your best portfolio is, and you stay with it, allowing for some rebalancing. You could say, hypothetically, if you had a 60-40, and out of your 60% equity, say 20% was foreign and 40% was domestic, you could take half of that 40, so maybe 20%, and do it by this, but leave everything else in the buy and hold, the strategic allocation. That's one possibility. And how quickly you get in and out, again, So much more research needs to be done. But this is actually, to me, really exciting because it can work hand in hand with a typical asset allocation. Or at some point, if we develop enough of these, if we have business cycle models that all are adding value globally, we could have a separate strategy that does business cycle model investing, and it could sit side by side with a strategic allocation that is essentially a buy and hold. Because again, if you think about what can happen in the future, we just don't know. We don't know if we're going to go through another one of these long periods. Japan is in one right now. We could be in one right now. If this comes way back down, we'll find out, wow, we've really been in a flat period for a long time. Doing something like a business cycle model, and particularly if we can take it global, would be sort of protection against one of these, because this process would generate better returns, or theoretically could generate better returns over this long flat period. So it's just a way to sort of deal with the uncertainty of the future. But again, this is all very preliminary. We got a lot of testing to go. But to me, it's very exciting, very interesting. Yeah.
So let's say you get your model to really work,
Okay.
and now everybody's doing it.
You're a dreamer, boy. You're better than me.
What's the economy going to look like in that situation?
Oh, I have no idea. I will happily contemplate that when the time comes. I have no idea. I mean, I actually have spent more time thinking about if more and more money keeps flowing into index funds, how actually that could impact markets. You would think if money is constantly flowing in at a fixed allocation, there's less efficiency in the market. I mean, that's just my intuitive question. I mean, if you took it to the extreme, if everybody was indexing and everything was going into indexing, what would help allow, provide for price adjustments among the stocks? So it's an interesting concept there. I haven't thought about if everybody were to follow us, but I said I'll be happy to think about that if we get to that point. Anything else? Yeah.
I have a whole pile of questions, so I'll try to condense it.
Okay.
So you're describing this model as though it's a thing, but it really sounds like a family of things where the parameters that you're evaluating have changed over time, and some have been preserved and some have been discarded, which means that the model is changing. So does that mean that you have to continue to do the back testing on the latest incarnation of the model, or are these results changing as the model changes compared to the S&P over time?
The former. So, and actually I would say that's exactly what research is designed to do. There's a big debate about sort of active versus passive management. The issue I have with active management is if you've got human intuition in there, that's nice, but you can't really rely on it to be consistent going forward. I'd much prefer to have some sort of algorithmic, systematic, whatever you want to call it, approach. Research then can continue to research these different approaches. And yes, it should be done because the economy is always changing. Capital markets are always changing. The economy is always changing. So yeah, right now the model is in its form. The model will not be updated for another year or two at least. If the model is updated, yes, we would start and retest everything to see if it still has the same efficacy as a useful tool in portfolio management. But the model right now, as it exists, is sort of in a fixed state, and therefore we can run these tests and hopefully find something useful in the information we're getting out of it.
And a shorter second part.
Sure.
As you've brought in new parameters and discarded other ones, has interest rates ever been one of these parameters that you've looked at?
Interest rates are in there in two forms. We have a short-term interest rate, composite interest rate, which is a, help me out, co-insider or lagger? Not one of the leaders. Yield curve is one of the leaders, so it's a 10-year, 1-year spread that is part of our leaders indicators. So yes, and it's interesting with what's been going on in interest rate monetary policy, the fact that interest rates are so low. But again, I don't know the future any better than anybody else does. Fundamentals would suggest at some point if the economy continues to grow, there'll be some inflationary pressures that will build. Fed will raise rates eventually, so interest rates are likely to go up at some point, no idea when. But we've got to go with what we have, and right now we have the history, and the 10-year, 1-year spread is a valuable indicator. So it is part of it. And this is all part of the business cycle model, the economic model, which the output of which is used for these back tests. Any other questions? Yeah.
This is essentially a market timing model from an investor's point of view, right?
I wouldn't categorize it that way. One of the things I wanted to emphasize when you looked at how often it traded, it's not trading that often. It's intended, it's designed to be an economic cycle model. So if we have no economic cycles, you won't be doing anything. You will simply be invested in whatever equity benchmark or portfolio you have. This is really meant to capitalize on economic cycles because we think the relationship is somewhat stable. We can go back and test it. But no, this is not, I wouldn't consider this a market timing. I think it's a fairly low frequency trading when you look at the amount of trading that happened in the model over the period of time. So it's to me, it's economic cycles. We're not trying to capture every little up and down. I don't know what drives the market up and down every single day, so I wouldn't even begin to try and do something like that. Any other? Yeah.
So I really like this model.
Thank you.
Some good work here. Have you made any personal adjustments to your personal portfolio?
No.
Based on
No.
your experience here over the past several months?
No, absolutely not. I'm telling you it's not ready for prime time. I believe it's not ready for prime time. Absolutely not. Please do not do that. Okay? I can't emphasize that enough. Please don't do that. This is really interesting, but it is not ready for implementation. Yes?
What percent of your allocation do you allocate to equities? Your personal?
Really, David?
Yes, I second that.
Can I really answer that? No. Okay. My lawyer has, my counsel has advised me against answering that. Any other questions that I can answer? All right. Thank you very much all for coming.